Welcome to this explainer. If you've ever felt the absolute sting of hitting a drawdown limit in a prop firm challenge, trust me, you are in the right place. Because here's the thing. Most traders actually sit down to trade these challenges completely blind to a massive mathematical reality. Okay, let's dive into this and uncover the crucial step that separates the consistent, funded traders from the ones who just constantly hit that breach wall. So, how many losing trades can you take today? I want you to seriously ask yourself this provocative question right now. Like, really, how many losses can you take today before your prop firm account is completely closed? It sounds incredibly obvious when we say it out loud, right? But the vast majority of traders out there do not calculate this. They know their risk percentage, sure. They carefully calculate their lot size. And then, well, they jump right into the markets without any real picture of how much runway they're actually working with. And you know, that gap in awareness is exactly what makes the difference between catching a drawdown early and walking straight into a totally devastating breach.
Real quick, here's our roadmap for today's explainer to solve this mathematical blind spot. We'll cover the prop trading fuel gauge, the 7-step runway calculation, total versus daily limits, a week in the life, and finally, when to adjust risk.
All right, Section 1, the prop trading fuel gauge. To really wrap our heads around this, we need to think about your account in a slightly different way. Think of your drawdown buffer kind of like the fuel in your car. I mean, you wouldn't dream of starting a long road trip without checking how much gas you have in the tank, would you? You'd at least check if you had enough to reach the next station. Well, prop challenges work the exact same way. You have a specific amount of fuel, which is your drawdown buffer, and every single losing trade consumes a little bit of it. If you run out of fuel before you reach your profit target, you're done. The whole road trip is over. The runway calculation we are about to learn is going to tell you whether you're starting your trading day with a comfortable 15 trades of runway or a highly dangerous 4 trades. You literally cannot trade those 2 days the same way.
Moving right along to Section 2, the 7-step runway calculation.
Let's move to the math and see how this builds into a simple 90-second morning routine that absolutely must happen before you open a single trading chart. Don't worry, we're going to chunk this math so it's incredibly easy to follow. Step 1, write down your current account equity. What does your screen show right now? Let's say it's $101,500. Step 2, identify your maximum drawdown floor. If you're with a firm like FTMO, for example, that's typically your starting balance minus 10%. So on a 100K account, your floor is a hard $90,000. Step 3, we calculate your total runway. You just take your current equity, $101,500, and subtract that $90,000 floor.
And boom! That gives us $11,500. This number is absolutely crucial. It's your total overall room. It basically represents the total financial buffer you have remaining before an account breach. It's the maximum amount of damage you can take in the entire challenge before you're completely out. But hold on, we aren't done yet, because prop firms have daily limits too.
So let's continue slowly here to make sure we get these next steps perfectly right. Step 4, write down today's daily loss limit. Using the FTMO hybrid method as an example, this is 5% of the lower of your starting balance or current balance. The lower of 100K and 101.5K is 100K, so 5% of that is $5,000. Step 5, calculate your daily runway. Take that $5,000 limit and subtract any losses you've already taken today. Let's just assume you're starting fresh, so it's $5,000. Step 6, now we bring in your specific trade size. Let's assume you use a 1% risk per trade, which is $1,015. We just divide our total runway of $11,500 by $1,015. That gives us about 11 total trades remaining. Finally, Step 7. We divide our daily runway of $5,000 by that exact same $1,015 risk per trade.
So if you divide $5,000 by $1,015, you get exactly 4.9. But, and this is a big but, you cannot take 0.9 of a losing trade without breaching. So you must always round down. That leaves you with exactly 4 daily trades remaining. This single number is your context for the entire trading day. Seriously, write it on a sticky note and slap it right on your monitor.
Okay, Section 3, total versus daily limits. We just calculated 2 very different constraint numbers. Now, what's really interesting about this is understanding how these 2 constraints interact. Why do we need both? Well, your total trades remaining tells you your overall breathing room in the challenge, which, in our example, is a very comfortable 11 trades. But your daily trades remaining, that is the immediate threat. If you hit those 4 daily trades, your session and potentially your entire account ends instantly. And that happens regardless of the fact that you still had plenty of total runway left. The lower daily number is almost always the binding constraint that rules your day.
Notice the visual comparison here. That massive first bar is your total runway. It feels pretty safe, right? But look at the middle bar, the daily runway. It's less than half the size. Now picture taking two quick losing trades of $1,015 each. That middle bar violently shrinks. Your $5,000 daily buffer becomes less than $3,000. You now have fewer than 3 trades left for the entire day. Seeing it visually like this really makes you realize why taking a third trade after 2 losses demands extreme selectivity. You are dangerously close to the edge of the cliff for that specific day.
Moving on to Section 4, a week in the life.
Let's bring this theory into reality and see how a hypothetical $100,000 account tracks these numbers across a standard 5-day trading week. And this brilliantly illustrates the natural rhythm of the market. On Monday, we start fresh, 10 total trades left, 5 daily. Say we take a net loss. So on Tuesday morning, notice our account balance is down to $98,800. Our total trades left drops to 8, but our daily limit resets, giving us 5 daily trades again. Now let's say Tuesday we make a great profit, bumping our balance to $101,200 for Wednesday. Notice what happens here. Our total trades shoot up to 11 because we have more profit buffer. However, our daily trades actually drop slightly to 4.9. Why? Because many firms cap the daily limit calculation at your starting balance. Even though we're in profit, our daily leash is slightly tighter based on our slightly larger 1% risk size. The runway expands and contracts dynamically. Doing this 90-second calculation gives you completely accurate context every single morning.
Finally, Section 5, when to adjust risk.
Now that you have these numbers, what actual behavioral rules must you follow? Because let's face it, data without action is useless. So the crucial point is this: your runway dictates your aggression. If you have more than 10 trades left, you're in a position of strength. Just trade your normal plan, nothing special. But if your total runway drops to between 6 and 8 trades, the yellow light is flashing. You need to pay way closer attention. Absolutely no grade B mediocre setups. If it drops to 4 or 5 trades left, you must protect your account. Reduce your risk per trade by 50% and only take textbook grade A setups. Finally, if you are at 3 trades left or fewer, you need to have a hard conversation with yourself. At this point, the mathematical probability of recovery to the profit target is incredibly low. Sometimes, taking the hit and just resetting the challenge is the highest percentage, most professional decision you can possibly make.
I really want you to remember this. Knowing your runway is not about restricting your trading. Without it, you're making decisions based on just a partial picture. Sure, you know your strategy, but you don't actually know the boundaries of your playing field. This quick 90-second routine stops emotional, reactive trading dead in its tracks. It replaces fear with calculated, context-aware decisions. It ensures you only push hard when you actually have the fuel to do so, and you pull back to protect your capital when the tank is running near empty.
Getting this math right every single day is completely non-negotiable for longevity in this industry. A proper system is going to automate these 7 steps for you so you can focus entirely on the charts, completely eliminating the guesswork.
I'll leave you with this. Every time you open your platform, you are stepping into a high-stakes environment. You now have the exact blueprint to calculate your fuel gauge, so the only question left is, are you ready to stop trading blind? Never start your trading road trip without checking your runway again. Thank you for joining me for this explainer. If you want the complete system I use, including templates and calculators, check out the Funded Trader Blueprint linked below.